Never a dull day in crypto. Hi, my name is Andrei Jikh. Hope you're doing well. Come for the finance and stay for the super important video because the SEC just flipped on crypto. They're threatening Coinbase with a lawsuit over their Lend product. And this is a huge deal because Coinbase sets the standard for all the other platforms in crypto. Whatever happens to Coinbase will inevitably happen to everybody else because it's like a domino effect. So if you're somebody who likes to keep their coins on an exchange and you like to earn interest like this guy does, then this will affect all of us because this could be the beginning of the end of earning that passive income. So in today's video, I want to go over exactly everything that's going on and explain like I'm 5 what's about to happen because it's super important. So let's jump into it. So first, full disclosure, I own Coinbase stock. So I have a vested interest in this company's success. I bought shares the day of the IPO. Rugrats, they don't lose money until you go to sell, is what I'll keep telling myself to go to sleep at night. Now, their latest product is something called Lend, and Lend is exactly what it sounds like. We lend our stablecoins, namely USDC, which remember, one coin equals $1, to other people to earn 4% interest. It's really straightforward. Now, at the bottom of that product page, there's 2 things. The first is pretty boring. Interest rates are subject to change. But the second one is much more important, and it's directly referencing the SEC. It says, Lend is not a high-yield USD savings account, and Coinbase is not a bank. Your loan crypto is not protected by FDIC or SIPC insurance. And this right here is where the real story begins, because this is where the SEC enters the chat and sends Coinbase something called a Wells notice, which is not at all what it sounds like. It's not like a get well notice. Instead, it tells Coinbase they're about to get sued. So the CEO of Coinbase, Brian Armstrong, started a tweet storm and it got a ton of attention for good reason. And here's what he said. Quote, "Some really sketchy behavior coming out of the SEC recently. Story time. Millions of crypto holders have been earning a yield on their assets over the last few years. It makes sense. If you want to lend out your funds, you can earn a return. Everyone seems happy. A bunch of great companies in crypto have been offering a version of this for years." Here, of course, he's referring to all the other companies like Voyager, BlockFi, Celsius that have been doing what essentially Coinbase is trying to do here. Then he says, Coinbase came out recently and said we would be launching our own version. We were planning to go live in a few weeks, so we reached out to the SEC to give them a friendly heads up and briefing. They responded by telling us this lend feature is a security. Okay, seems strange. How can lending be a security? I'll answer that in a moment, by the way. So we asked the SEC to help us understand and share their view because we always make an effort to work proactively with regulators and keep an open mind. They refused to tell us why they think it's a security with zero explanation. All right, on the surface, it does seem like Brian has a really good point. Why would the SEC try to sue Coinbase over stablecoins if the SEC has never clearly defined stablecoins as securities? Securities are things like stocks, bonds, treasury notes. That's what they are when we think about them. But there's a plot twist. There's 2 important things we need to understand first. And the first one is something called the Howie Test, which I've talked about before, but no one paid attention because it wasn't as relevant, but now it's really important. The Howie Test is the brainchild of the Supreme Court, and they created it to figure out if something is a security. And it does this by asking one really easy question. Is it an investment contract? And there are 4 ways to figure out if it is. Number 1, is it an investment of money? In this case, holding USDC is not an investment, so I would say this does not apply. Number 2, it asks, is it in a common enterprise? Yes, it is. Coinbase is a common enterprise. Number 2 is a check. Number 3, is there an expectation of profit? We expect to earn interest on our money, so absolutely there is an expectation of profit. Number 3 is a check. And number 4, is it derived from the efforts of others? In this case, other people take the effort of borrowing our money, which we then earn interest on. So in this case, number 4 is also a check. This right here means that we fail 3 out of 4 of the Howie questions, the Howie test, which means more than likely we are a security. And unfortunately, this is just a really outdated, really old test that the SEC uses to figure out whether something is or isn't a security. Now, let's say you disagree with me on all of this and you have your own opinion, that's fine. But there's something even more bulletproof as an argument against us, and that is the Securities Act of 1933, and it's super duper sneaky, and this is why crypto's really in trouble. This is directly from the document. The term security means any note, stock, treasury stock, security future, security-based swap, bond, debenture, I've never even heard that word before in my life. We're going on a debenture! But anyway, it goes on to say something really interesting. This is the most important part. Evidence of indebtedness, certificate of interest, or participation in any profit-sharing agreement. So clearly, the Securities Act of 1933 on literally page 1 has the words indebtedness and interest in it. And that means technically because someone is going into debt by borrowing our USDC and we are then earning interest on it, this can be clearly argued in court that this is indeed a security. But this is a digital currency. This is a digital asset. That's not really going to stand up in court. That's like saying, well, this is different because it's got ones and zeros and it's on a computer screen. And if you think about it, it makes perfect sense because in 2008, when we had the collapse, that happened as a result of greedy lending of debt securities. That is why debt and lending can be classified as a security, even though when we think of securities, we think of them as things, like stocks and bonds. They're nouns, whereas lending is more of a verb. But again, we lent debt securities in 2008 and we had that collapse. It was the SEC's job to make sure that that didn't happen in 2008, but it did anyway. And that's how we can classify these USDC coins and lending them out as a debt security. And this should not be a surprise because BlockFi has been dealing with this exact same problem. If you remember earlier this year, BlockFi's interest rates were in the mid 5% range. It was amazing. And then they dropped the rates, which is weird because now Bitcoin and crypto has recovered, but their rates never did. Check this out. This graph shows the green line of Bitcoin, which is the price going up, the blue bars, which are interest rates, which you can see have stayed flat, and the second tier, which has also been decreasing despite the prices increasing. So what does this mean? This means there's some external factor that's affecting these interest rates, and I could be wrong, this is my non-professional opinion, but I think it's because states have started to issue cease and desist letters. States like New Jersey, Vermont, Kentucky, Texas. What's wrong with you, Texas? You're supposed to be the crypto hub here. But these states have basically told BlockFi, you violated the Securities Act. That's the thing I showed you. And because you're not exempt from registration, we are classifying you as a security, therefore you should cease all operations. And this is really sad because it looks as though states have started to crack down on crypto and they're making BlockFi an example, and maybe they're going after Coinbase next. Now, nobody asked, but here is my personal thoughts on what's going on and where we're going next. I don't want to put on my tinfoil hat and tell you some crazy theory, but I have to share with you the most popular one that I've seen on the internet, which is the most cynically obvious one, which is that the SEC has a close working relationship with the banks and they have an incentive to protect the legacy banking system. Because if you think about it, what would happen if the SEC allowed these platforms to exist and to continue paying us 5% on stablecoins, currencies that are arguably just as good as the dollar because they're stable and they're not volatile, they don't fluctuate in value? At that point, you'd have no incentive to keep your money in the bank when the national average is 0.06% on your savings account. At that point, you just transfer it over to these platforms where it's equally as safe and you'd earn 10 times more instead of having your money eroded by inflation. So if you use the follow the money logic, it makes perfect sense why the SEC has this newfound pressure to regulate what's going on. And this kind of narrative is also helped by people like Brian Armstrong, the CEO. He's like, who are they trying to protect here and what's the harm? So he's like, oh, maybe they're protecting the banks here, right? So that's theory number one. The second theory is something that I came up with that I think is far closer to the truth and much more interesting than anything you've seen on the internet so far. Right now, regulators have no idea what they're dealing with. They don't understand crypto. Pokemans, you whippersnappers, when I was a kid, the SEC has a responsibility. On one hand, they need to make sure that 2008 doesn't happen again. But on the other hand, they can't blanket ban crypto and stablecoins because that would limit innovation. And if we did that, people would create those jobs, that technology, and those opportunities somewhere else. We don't want to do that. But we also want to make sure things don't spiral out of control like they did in 2008. How do we do that? Enter Gary Gensler. He's like the good guy, bad guy in this story, but he's the bad guy because his job is to regulate this stuff. He's the head guy in charge of the SEC. He regulates things very hands-on. He looks at every platform and every coin on a case-by-case basis. And to the outsiders, it looks as though he's playing favorites. For CEOs like Brian Armstrong, he feels singled out. Why is Coinbase not allowed to do this when BlockFi and Celsius and other platforms can pay interest to customers, but we can't? That's not fair, Grandpa. And Gary's like, well, that's too dang bad. He's like the parent who's really bad at explaining. So let me just explain Gary's perspective in a way that's a little bit more eloquent and makes sense. This is not me trying to side with regulators. I just think we stand a higher chance of winning if we truly understand the opposition's perspective. The truth is, every institution makes money in different ways. Voyager, for example, pays interest based on the profit it makes from the bid and ask spread on their customers. So for example, if you were to buy $1,000 worth of Bitcoin on Voyager, they would find that Bitcoin for $999 and they get to keep that dollar. And with that $1 of profit, that's what they would use to pay us interest. That is not the same as Coinbase's interest model, which lends our stablecoins to their clients. That is perceived as a much riskier model than what Voyager is doing. So even though the end result looks the same, clients or customers earn interest, it is mechanically very different behind the scenes on how we do it. So the SEC is more so paying attention to the mechanics of how this interest rate model works and the sheer size. And because Coinbase is exponentially bigger than Voyager, it has a lot more influence over the crypto industry that Gary feels like he needs to keep a closer eye on. That is why some platforms are less regulated. That's why some coins are less important to the SEC because of size and the interest rate model, and not necessarily because they're trying to protect the legacy banking system. Or maybe I'm just naive and that's really why. But now for the most important part. What does all this mean and where are we going? Long story short, interest rates this year and the next will most likely fall substantially, as crypto companies will probably want to play it safe and just wait it out. So it looks as though the SEC has chosen to do regulation through litigation, right? They don't want to talk anymore. They just want to sue companies and send them cease and desist orders. And the reason for that is not because they're necessarily malicious or evil. It's just because that's how they like to play catch up. It's like, cease, desist, wait, we're going to sue you. They scare these companies and they're like, guys, bought us some time. Let's figure out what are these technologies? What is actually going on? The thing about innovation is that it has no patience, especially in the space of crypto. Crypto does not need permission. That's why when I started talking about crypto at the end of last year, I said that the biggest threat to centralized finance platforms like the Coinbases of the world is going to be regulation. And the biggest threat to that regulation, and the answer, will be DeFi platforms, right? The decentralized finance platforms where nobody owns those. It's like the LimeWire of finance, where everybody sort of torrents, but nobody owns the thing. It's just like everybody contributes to the trades, and that's where people will earn their interest. Because how long are people going to keep their crypto on the exchanges where they're earning 0.5% before they realize, hey, I'm taking all this risk anyway, I might as well move it to a DeFi platform where I can earn more money. Or maybe we all get along. Or maybe the government creates their own stablecoin and we get interest on that. That would be interesting. No pun intended. Either way, that's what's going on, and you've been filled in. That doesn't sound right. In the meantime, don't forget to have a great rest of your day. As always, subscribe. If you haven't already, smash that like button. Go get up to $250 worth of free Bitcoin with this BlockFi link right here, blockfi.com/Andrei. Go get your 2 free stonks with Webull when you deposit $100 with my link down below. Go track them automatically with a spreadsheet link down below in my Patreon. Love you. Thank you so much for watching this video, and I'd love to know your thoughts. I tried really hard to research this and not just give you a flat out answer like legacy banking systems, but it makes sense, but I'd love to hear what you think. I'll see you soon. Bye-bye.